Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for September 15th, 2018. Let's get started with a brief kind of week in review. We're going to actually look forward quite a bit to this next week of trade. First and foremost, markets, of course, depending upon which markets you're going to look at, are at or near all-time highs. In the SPX specifically, that's the S&P 500 index options, we stayed inside of the expected move. Now, for those of you that do tune in on a week-to-week basis, we talk extensively about expected move. That's how the option marketplace depicts risk moving forward. Well, that expected move last week was $42. And I gotta tell you, that's a big boy expected move. And although we kind of, strive to hit the upper end of the expected move, and we got close on Friday, we stayed inside the expected move once again. For those of you that are keeping score, in the last 23 weeks, 20 of the weeks, 20 out of 23 have now been inside of the expected move. Now you remember, for those of you that know a little bit, of your expected moves, the expected move kind of delineates about 68% of all occurrences, except right now you have about, and again, this is since about April 1st, you've got right in the neighborhood of almost 87% of the time staying inside of the expected move. So there is statistical significance effectively to that. Now, let's just move forward, and talking about the SPX here, move forward to this next week. The next week, we're actually looking at a $30 expected move. So I'll show that here a moment in the charts, but we're actually going from this week where we had this $42 expected move, right? We were looking for some volatility, and we actually got some volatility later in the week, but all of a sudden then, this next week, volatility absolutely collapses. Now, granted, there are a couple of Jewish holidays coming up this next week where, although markets are open on Wednesday, it's going to be relatively dead right smack in the middle of the week. In fact, I noticed they even moved a couple of the bond auctions and so forth into the latter portion of the week. So what's really in scope right now? Let's just, cut all of the expected move talk. What's in scope right now? What are you looking at? What are you thinking about doing? Well, one of the things that's really grabbing my attention once again is bonds. It's rates. I talked about it last week. Talked about it incessantly throughout the course of the week in TheoTrade's, chat room, but nevertheless, it's all about bonds, it's all about rates. If you're, looking at rates, rate fears are about to surface once again. You might not be hearing a lot about it in markets right now, but you will, That train is never going to be late, and that is the 10-year is actually sitting right now at 2.99%. So that threshold of 3%, everybody starts to get a little nervous in there. Obviously, earlier this year, and back in, late January, early February, we really had interest rate fear. I believe that fear is going to start to come back around. But this time, it's going to be vastly different. Why? It's not the 10-year that has really caught my eye. It's the 2-year versus the 5-year versus the 10-year, and you're actually got almost a completely flat yield curve. We're almost literally a few basis points away. The yield curve could flip as early as this next week, and right now I would fully anticipate it to do so. And that's where everybody's starting to get nervous. They're like, well, the yield curve, can the yield curve actually flip over? Because really, in terms of an indicator, it's a little scary. It's, that's always a sign of recession. I'm not necessarily saying that is going to be my opinion right now. In fact, it's anything but. I think the Fed influenced this so much that we not even worry about the idea of recession. But the inversion of the yield curve itself is going to cause apprehension. It's going to spark volatility back into the S&Ps. That, it's probably going to coincide with the fact that we're going to hit the midterm elections. So bond and rate fears are going to be very prevalent. I'll show you that in just a few minutes. The other thing that I'm really focused on right now is what I would call sector rotation. Now, sector rotation just happens to be, for instance, Amazon down. What's popping up in its place? And we're just seeing this on a day-to-day basis. Like the marketplace is playing this wild game of whack-a-mole. If you have no idea what I'm talking about, it's a wonderful analogy for the marketplace. You literally whack down one sector, another one pops back up, right? I think the game had a little pig in it, and you whack it with the stick, something like that. Anyway, You whack down one sector, you whack down one individual stock, another sector pops up. Last week, what were they doing? They were whacking a little bit of the financials, a little bit of tech got hit, and all of a sudden you had the energy sector pop up. All right, this week you've actually seen Amazon take a little bit of a hit. Other tech is now popping back up, and it's been, again, this consistent game of whack-a-mole, which I'm going to display to you in terms of sectors here momentarily. It's a lot to think about, okay, moving forward. But one thing that's going to really resonate with me this next week, the volatility is incredibly low right now inside of the S&P, incredibly low. If you either need hedges for downside protection, this next week is going to be an excellent time to put those hedges on. Or, okay, let's actually switch gears for a second. If you're looking, okay, to scalp on an intraday basis, you want to get all over buying options, get long gamma on an intraday basis. Why? Because some of the days here are showing like 8% implied volatility of at-the-money options, and the week hasn't even began. So it's extremely low implied volatility in a time of where there's a lot of apprehension. You got interest rate risk, you got trade war. I can go on and on for a half an hour on that. With that, let's take a look at some of the charts.
To the charts we go. All right, what are we looking at to begin with? Well, what looks like spaghetti on the middle of your screen happens to be none other than a comparison specifically of individual sectors. And there's a few things I just want to point out before we start to really dig into this a little bit. And again, this is kind of what I would term the wild game of whack-a-mole. But first and foremost, that's it's just a 1 month. Now, the spider is my primary product. And each of these other ones, it's like the XLU, the XLF, the XLK. I've got healthcare in here. Again, it's many of your sectors. And this is something I can absolutely share the chart on. But what I wanted to talk to you about specifically here is, again, kind of this wild game of whack-a-mole. And to show you and display this, yeah, we can look over here at the individual sectors, right? And what you're effectively getting when one sector gets knocked down, another one pops back up. Ironically, the one I'm pointing to right here, that happens to be financials, which has been sold off. Okay, in most of the last 2 weeks, financials have been, sold down. But the point I'll make over here is, so on a 1 month basis, if you look at the line that's outperforming, it happens to be specific to the XLY. Now, that happens to be what? Okay, kind of retailer discretionary. The XLY, its primary component, is none other than Amazon, which is, again, the XLY is now dipping. But that's on a 1 month basis, okay? And the second top performer is the XLV, which is healthcare. Now, let's just flip the time frame for a second. Let's just go from a 1 month to a 3 month. And it's a completely different picture, okay? On a 3 month basis, the outperformer, it's the XLU. Like, really? That's the utilities, okay? What's the second best performer? Well, healthcare is still up there in that particular circumstance, and all the way to the bottom over here, the underperformer happens to be energy. So again, now we'll flip back once again to the 1 month. You go back over here again to that 1 month, and you're going to see, well, energy is actually doing, it's quite well in this, okay? And there's, by the way, there's financials. Energy is actually propping up quite well in the midst of this. So again, it's this constant need for fund managers. They are pushing the edge of returns, okay, without really discretion at all. And one thing I really want to point out, again, it's a wild game of musical chairs, okay? And eventually this music kind of stops and hopefully you have a seat. But I want you to put yourself, okay, in the perspective of a fund manager. And a fund manager, they continue to get allocations from 401ks. And in any major mutual fund, and very few people know this, in any major mutual fund, they have to put often a minimum of 95% of the capital that's coming in. They have to put it to work. So what they're doing right now is, listen, do you think, okay, that these fund managers don't see underlyings like Amazon the same way we do? Okay, they're looking at it. They know. I mean, come on. Look at the Amazon on a year-to-date basis, up 65%. And they're like, yeah, well, we have nothing else to do. We have to put capital to work. So effectively what they're doing is they're like, all right, so this week it's the theme of what's working right now. This week we're going to sell Amazon, and what are we going to turn around and buy? We're like, well, we haven't bought any Apple in a while, so they'll turn around and buy Apple. It's this constant kind of rotation playing, all right, out in the marketplaces. This week, okay, this week, it was energy. energy, which has just been like, kind of dismal throughout the course. This is year to date on a percentage basis, fairly dismal. And very much out of favor. All of a sudden this week, energy, it shot up by the tune of what? It was down, what? 2.5%. It actually shot up. Now it's up 1%. So almost 3% move to the upside. Okay. And you can just go on and on. If you take a look at the financials over the last few weeks, nobody's wanted to touch financials. On Friday, they're like, oh, well, on Friday, it was sell Amazon and Google day and turn around and buy the financials. And that's where, again, you can call it either the game of whack-a-mole or musical chairs. In the short term, it's whack-a-mole where you knock one sector down, another one pops up. In the longer duration, it's absolutely the game of musical chairs where somebody's going to be left without a seat. Again, this is just fund managers without really, using much discretion, throwing money into the marketplace. And that's the first thing I really wanted to mention on here. The next thing I want to mention kind of in this weekend video, and I think that this is absolutely critical. This is the ZT. A lot of people don't pull up the ZT. It's the 2-year Treasury note futures. All right. And whatever. It's a futures product. Like, don't get nervous. But I just want to show you the 2-year again over the last 10 years. Now, this is not what we term contract adjusted. So we come over here to futures, adjust for contract changes, hit apply, hit OK. Point I'm making, the 2-year, this is real now. And again, I displayed this exact same thing last weekend, but I just can't stress to you enough. This is real. We are breaking down on the 2-year. Look at the 2-year. This is a 10-year weekly. That's the last 3 weeks. In fact, I think it's worth drawing your attention and actually zooming in. Okay. This is just the last now 3 months. That's Mr. Toad's wild ride. And that's why I'm saying the yield curve is going to invert or completely flatten out. And I stress to you, this is the area of concern. Okay. This is what's going to spark the next area of volatility inside of the S&Ps. And it's like a merry-go-round. I'm full of analogies this weekend. It's a merry-go-round of fears. And the fears just keep resurfacing. A couple of months ago, trade war fears. A few months before that, it was interest rate fears. The irony is right now we should have trade war fears. We don't. Okay. But the interest rate fear is absolutely going to come back into play, which also brings me over back into the emerging markets, which I've talked about extensively. In the emerging markets, they bounced. And this is exactly what we were looking for this week. They bounced. Okay. And at this point in time, they may have a little bit more upside into them. But we're there. We're there to where I think we can get a decent entry point, okay, to the short side of emerging markets. The short side of emerging markets. I would prefer, okay, to see the emerging markets hit. And I want to be incredibly specific with this. I want these things to hit right around 42.50 before I'm probably going to step in and short them. And I do not have a position, okay, in the emerging markets. So what I'm doing right now is I'm trying to take what I see in terms of interest rate fears that are going to resurface, right? And I want to translate that to trade for you. And in the emerging markets, that's going to be the first one. The next one up, okay? The next one up where I absolutely do have positions is the XRT. Inside of the XRT has been one of the best performing sectors. Now, zoom out for just a second. I don't want to short the XRT because it's retail, because the retail apocalypse, was here 18 months ago, but now it's the best performing sector. Forget all that. Forget about any of your directional bias. Okay. What is going to start to be discussed is the fact that retail, okay, isn't going to look so rosy when the credit card debt starts to rise. And that is, consumers are going to be less likely to want to open up their wallets, even if the economy is rocking, when they start hearing about interest rate fears splattered all over the financial media and, okay, in the general media. And it's retail, okay, that often suffers in the midst of just that. If you don't believe it, just look right back here. Okay, this was retail. This is the last time interest rate fears were really sparked. And the interesting irony of that is you saw sell side activity hitting retail before it started to hit the brunt of the marketplace. Nevertheless, retail rebounded spectacularly. Again, I have numerous positions inside of retail. All right, some duration positions, some deep in the money puts that I've purchased, and I've purchased those puts to take advantage of the downside inside of retail. Next sector up. Okay, what else? With interest rate fears, home builders. Okay, now the home builders, this is a position that I exited Okay, I exited the home builders not that long ago, but I exited it just under the $39 level. It's popped back up now, okay? And, entering it in this immediate time, and just look at this on a year-to-date percentage, it's still down 10%, okay? In the home builders, I'm going to be a little bit, okay, more selective. I believe that the home builders could still have some more upside, but make no two ways about it. I want to get into the short home builders. Now, you have to be a little bit careful, though, in XHB because some of the primary components in XHB, something like Lowe's, Home Depot, which have actually performed well because of a wild hurricane season. So in effort to really establish a position in here, let the underlying get bid up a little bit more. Okay, it's an ETF product. Don't feel like you're going to miss it. But I wanted to give you, again, the XRT, the XHB, okay, and the emerging markets. And there's one more where I think interest rate fears are going to play out. And for those of you that know this, I already have positions in here. JP Morgan, specifically JP Morgan. I've talked about this ad nauseum at this point. Here's still a decent entry point. Now, we've already had this position on for a while. Our position happens to currently be profitable. We took an absolutely monstrous roll out of this thing. $15 we received, specifically $14.80 credit for the first roll inside of JP Morgan, which is knocking it out of the park on that particular position. Last, but definitely not least, so we know that we're just wildly rotating from sector to sector. And it feels, okay, when that's going on, it kind of feels like markets are very much aimless. And I can't stress to you enough, they absolutely are. When I say the market is aimless, like, but Don, it's at, all-time highs. And it has been, okay, since basically January. But when you start looking at the advanced decline line, this speaks volumes, okay? The market is completely and utterly bifurcated right now. There's nothing wrong with that. However, on a day-to-day basis, you're going to look at this one day, you're going to come in, and you're going to be shocked because it's going to be 90 or 100 products on one side or the other. And you're going to know at that point, that's the change that you're looking for. And again, this entire year, even though we're sitting at or near all-time highs, okay, this entire year, you have to trade for it. When I say you have to trade for it, okay, markets really haven't done a tremendous amount. Again, on a year-to-date percentage basis, but Don, they're up 7%. Yeah, well, the year ain't over either. Okay, there's a whole lot of risk out there, and the year is definitely not over. Now, moving forward, okay, as I said, the SPX expected moves, and I like to kind of delineate these each and every week. So last week, we're coming off a $42 move, right? That's a $42 move. That was what was really implied by the option. And we came just shy of the expected move. Literally, just missed the upper end of it. But all of a sudden, we go from a $42 move to what? A $30 move higher or lower. That's it. You got a $30 move, which I'm telling you, this next week, and one of the reasons, though, that the expected move is so light, and again, very few people are aware of this, okay, it's Jewish holidays going to fall on Wednesday. And it's kind of like the unspoken time where, yes, Wall Street happens to be open. Nevertheless, okay, there's not going to be a huge amount of activity on Wednesday of this week in low liquidity kind of trading session. And that's actually, it's amazing because it's priced into the S&P options. The other thing is we have a primary expiration week. That is, this is the September expiration. The futures are rolling over. We're going to laugh. We're going to cry. But on a $30 expected move, I'm going to tell you exactly what you should look for in a $30 expected move. For those of you that trade on an intraday basis, okay, intraday basis, take a look how low some of those implied volatilities are. Now, that's the entire week. You realize the at-the-money options, okay? I was talking about 8% a minute ago. These are at 6.6%. You actually gotta look to find like the 8% in here. But for the most part, the options are just dirt cheap. You can't go out and want to sell these. I mean, you want to sell something with 5.83% implied volatility, the at-the-money option? No, I'm going to be a net buyer. Why? Because one of the days this week, we're going to be rocking. And that's the whole, the key to this is to understand, all right, that during the actual trading days, that there's very likely going to be, all right, a period throughout the course of this week where we wildly exceed what was expected on an intraday basis. And there is huge edge in this kind of trade as of late. That is, being a buyer of premium, know the right option to purchase, low implied volatility, okay, even if you're right, less than half the time, okay, the fact that the implied volatility is so low is still going to be beneficial, meaning you could be right less than half the time and still pull out a degree of profitability. For those of you that trade on an intraday basis, I'm telling you, this is the place to look this next week. Thanks everybody for joining us here at TheoTrade in this weekend update. Have a wonderful weekend. Bye-bye.